With the ISM dropping down quite convincingly below the 50 level in the September reading, markets are once again turning their attention to an increased likelihood of recession. So in this brief video, we're just going to investigate previous occasions when the ISM has declined by 50. But let's just start and to look at the implications for markets. Let's just start with a quick overview of the ISM manufacturing index. As you can see on the chart there, falling to its lowest levels now, uh, really, or in line roughly with the 15-16 decline, but certainly towards the lower end. So quite a strong downturn in the ISM index. If we look at across other key regions, the dark blue here is the US number, so you can see that that's fallen away quite sharply. Now on track, if you like, with the European PMI, which has fallen to even lower levels. And interestingly, in there, the green line is the Chinese PMI reading, the one that's focused more on the private sector, and that's actually appears to have stabilized and even picked up in the last few months, and that hasn't got nearly as much attention as the decline in the advanced economy PMI. Sort of an interesting note. What does that mean? Well, we produce a measure of growth momentum at the G4. When we say G4, we're saying US, Europe, Japan, and China, and that's the red line here. So it's basically a momentum index. The blue line here is global industrial production growth in an annual sense. So basically, what we look for is periods when the red line, growth momentum, is above zero, and that normally leads to an inflection point in the cycle itself. So at the moment, we're still well below zero over here on the left-hand scale, although there was a slight kick up despite the downturn in the ISM, and that partly reflects the improvement in the Chinese data compared to the last 12 months. So some mixed messages coming through this G4 momentum. It's still in negative territory, still not pointing to a turn in the cycle. Even though where the cycle has got to is broadly in line with the past two mini cycles, 2012, 2015, 16. So why do we spend so much time, I guess, looking at these sorts of measures, growth momentum? Well, what I'll just have a look at here is we'll have a look at market performance. Monthly, I'm just going to do monthly market performance when the PMI is below zero. So let's just have a quick look at that. And in the case of US equities, basically what it's meant, so since probably the late 70s when G4 growth momentum has been below zero as it is now, I'm looking at monthly returns from the S&P 500, 0.3% versus 1% when it is above zero. If we broaden that out to look at, say, emerging markets, when growth momentum is below zero, emerging markets have done negative 0.3 versus 1.4 when it's above. If we look at, say, small caps in Australia, 0.14 versus 1.18. And then if I look at returns, say, from a US 10-year bond, obviously bonds like periods such as we're in at the moment, 0.9% average monthly returns as opposed to a small negative. So, it does sort of have implications obviously for asset classes. Now, let's just then have a look at events. So the event that we're talking about is the ISM being below 50. And so let's just have a look. So these are the periods we're showing now when the ISM has been below 50. Just going to flick that on. So we're looking at all periods since the late 1970s. You can see the pathway of the ISM during those periods in the past. So what I guess we're sort of interested in, what else is going on in the economy when the ISM is going through 50. If we look at we'll look at the non-manufacturing index. Now that's only really been around since 1997, but it's broadly followed the ISM manufacturing index to lower levels. What about GDP growth? As we can see here, GDP growth, this is 6-month change in US GDP is also, we've had mixed responses. GDP sometimes has been managed to stay up at reasonable levels, and then other times we've had recession. So we thought we'd then have a look at a a look at the performance of the S&P 500 during these periods. So you can see here, this is a mixed bag. So 0.0 here is the point at which the ISM goes below 50, and these are the lines is the subsequent months. So for example, there's one period where the ISM was below 50 for more than 24 months, as we can see there, but quite a mixed range of outcomes from the S&P 500. So we thought we should sort of break it up into recessionary periods and non-recessionary periods. So here, what I'm looking at here, these are the recessions. So so we're looking at these periods here. So I'm looking at the 79, 81, 89, 2000, 2008. So they're the recessionary periods. You can see the performance of the S&P 500 obviously flat at best, really, before some sort of recovery later in the downturn. And if we look at, we just change that around so that we're now only looking at non-recessionary periods. I'll just do those. We get quite a different result. Market, after a brief setback, has generally climbed. So if we put that into a table here, so what I did is just have a look at the ISM below 50. There have been, including the current occasion, there have been 12 occasions since the late 70s. 12 occasions. On 5 of those occasions, the US economy has ended up in recession. In these columns here, I'm looking at, well, what was happening to the ISM Services Index and what was it doing? And I think on 2 occasions, we saw the service sector ISM actually go below the 50 level, but there are convincingly below, but there were 3, possibly 4 other occasions where the service sector index did not really fall that far at all. And so I guess that's the discussion at the moment, is that the service sector, although it has been coming off, is still above the 50 zone and not conspiring with the decline in the manufacturing sector. If we look at the performance of the S&P 500 over the subsequent 5 months and subsequent 3 months, 6 months, and 12 months, what we can see here is you can see they're the 3-month performances after the ISM's gone below 50. That's the next 6 months and that's the next 12 months. So there's a whole range of outcomes. So we looked at the recessionary periods. We find that the S&P 500 has averaged about 1% gain over the subsequent 3 months, basically flat over the 6 months and down by an average of 7%. The red marks those recessionary periods. So there's been a range of outcomes from a sort of positive 16, positive 18 through to a negative 43. And in the non-recessionary periods, market's been basically flat in their first 3 months, up by 6 over 6 months, and up by 22.5% over the subsequent 12 months. So clearly, very important distinction to be made. Just looking at the ISM below 50 doesn't necessarily mean a very negative outcome for the US equities and equities more generally. Obviously it depends whether the rest of the economy slides into recession, follows the manufacturing sector into contraction. But for now, the evidence still suggests that the downturn is broadly confined to the manufacturing sector. Yes, it's having some spillover effects, and clearly what happens on the trade front and in terms of Fed policy action being a bit more ahead of the curve is going to be significant factors in determining how this plays out. Thank you.